Picture a river. Not a trickle, a massive roaring river carrying trillions of dollars of capital, moving through the global financial system every single day. Now picture a dam, not a natural dam. A man-made one, built out of confusion, legal gray areas, and unanswered questions. And for the past year and a half, that dam has been holding back a flood of institutional money that was ready to pour into crypto but couldn't, because nobody could answer the most basic question in finance. What exactly are we buying? That question: is this a security? Is it a commodity? Who regulates it? And can my legal team defend it in court? That question has been the single most expensive unanswered sentence in the history of digital assets. But today, something is happening in Washington that could finally answer it. And if you don't understand why that matters, you're going to miss one of the most important setups this market has seen in years. Let's break it all down. Here's something that almost nobody is talking about, and it should be the headline of every financial news outlet right now. The total amount of money circulating in the global economy has never been higher. We're talking about a number so large it almost loses meaning: over $121 trillion in global money supply. And in just the last 2 years, that figure grew by roughly $17 trillion. To put that in human terms, if you stack $17 trillion bills on top of each other, you'd reach the moon and back twice. Now here's the question that should be keeping every crypto investor up at night. Where did all that money go? It didn't disappear. It went to places where the rules were clear. US equities, treasury bonds, real estate and stable markets. Even gold had a historically strong run. Capital flows toward predictability the same way water flows downhill. It's not a preference, it's physics. Crypto, for all its potential, was sitting behind that dam. A barrier built not out of skepticism about blockchain technology, but out of genuine, legitimate legal uncertainty. Think about what it takes for a major asset manager, someone running pension money, endowment money, family wealth, to approve a new asset class. They don't just need to believe in the upside, they need a legal opinion. They need a compliance framework. They need to know that their software vendors, their custodians, and their trading desks aren't going to wake up one morning to find themselves on the wrong side of a federal prosecution. Without those answers, the money waited, and it's still waiting. But the gate is starting to open. Let me give you a real education on what's happening with crypto legislation right now, because most of what you've heard has been oversimplified. There's a bill working its way through the Senate focused on bringing structure and definition to the digital asset market, and today a critical committee vote is happening that determines whether it moves forward. Now here's what the mainstream coverage gets wrong. They frame this as a crypto bill like it's a favor to an industry. It's not. It's an infrastructure decision. Think about what happened with the internet in the 1990s. The reason the US became the undisputed global leader in tech wasn't just talent or capital. It was policy clarity. Section 230, Safe Harbor provisions. Clear frameworks for what platforms were and weren't responsible for. Those decisions, boring as they sounded at the time, became the legal bedrock that allowed Google, Amazon, and Meta to be built. We're at that same inflection point right now for blockchain. The bill being debated solves two things that matter enormously. First, it answers the securities vs commodity question. This is the classification battle that's been raging since 2017. Is Bitcoin a commodity? Most agree yes. What about everything else? Right now, that answer changes depending on which regulator you ask, and that ambiguity is weaponized in every lawsuit, every enforcement action, every board meeting where someone says we can't touch this yet. Second, and this is the one that I think is drastically underappreciated, the bill addresses developer liability. Right now, if you're a software engineer building tools on a blockchain and you don't touch a single dollar of user funds, you could theoretically be prosecuted under the same laws that govern banks and money transfer. Businesses, that is insane. That's like prosecuting the people who build ATM software for the decisions made by the bank that owns the machine. This provision protecting non-custodial developers isn't just about fairness. It's about whether the United States gets to lead the next generation of financial infrastructure or whether it cedes that ground to jurisdictions that don't have this problem. Last-minute negotiations hit a snag on this exact point, and on a separate track, there are Democratic senators pushing for ethics provisions, essentially demanding assurances about conflicts of interest at the highest levels before they'll add their names to the bill. These aren't trivial concerns, they're actually signs of a mature legislative process. Both sides want something real out of this, and that tension, frustrating as it is, tends to produce better law than rubber stamp votes. The expectation heading into today's markup is still cautiously optimistic. But cautiously optimistic in Washington means you watch the amendments as carefully as the vote itself. Now I want to zoom out for a second because there's a second variable in today's market equation that has nothing to do with crypto legislation and everything to do with how risk assets move globally. Right now, the United States and China are sitting across from each other at the negotiating table for high-level economic talks. On the surface, these conversations are about trade, technology transfer, and the economic relationship between the two largest economies in the world. But underneath that, there's a thread running through these talks that markets are watching very carefully: Taiwan. China has been increasingly explicit that its position on Taiwan's sovereignty is non-negotiable and that how Washington handles that issue will shape the entire tone of economic cooperation going forward. That's not a subtle diplomatic signal. That's a direct linkage between geopolitical posture and economic partnership. Here's why this matters for crypto specifically. When geopolitical tension spikes, when there's genuine fear of miscommunication or escalation between major powers, capital doesn't just rotate. It flees. Risk assets across the board get hit. Equities fall. Crypto falls faster, and all the legislative goodwill in the world doesn't stop an algorithm from selling when the fear index crosses a threshold. On the other hand, if those talks conclude with even modest signals of economic stability and cooperation, you get the opposite. A relief rally across risk assets, renewed appetite for growth plays, and crypto, which tends to amplify directional moves, would likely benefit disproportionately. So today you're watching two rooms simultaneously, one on Capitol Hill, one in a diplomatic meeting somewhere between Washington and Beijing. And the outcome of each one has real power over what your portfolio looks like by the weekend. Let me give you some real context on where things actually stand before you make any decisions. The market has been under pressure. Bitcoin slipped below the psychologically important $80,000 level before recovering. Ethereum has been trading in a tight, indecisive range. Solana, which had been building momentum, took the sharpest hit after inflation data came in hotter than expected, a reminder that macro still has more control over this market than most crypto-native investors want to admit. XPRP has held relatively better than its peers during this pullback, not immune but more resilient, and that relative resilience in a down environment is actually meaningful data. It suggests that there's a different kind of buyer in XPRP right now, one who's holding through the noise because they're positioning around the regulatory story, not just trading the chart. The inflation data, both consumer and producer prices running hot, has raised a real fear that the Federal Reserve won't just hold rates where they are, but might actually consider raising them again. For crypto, that's a headwind. Higher rates mean the opportunity cost of holding risk assets goes up. But here's the critical nuance: this kind of fear, baked in uncertainty, is rarely the ending of a market story. Historically, assets with genuinely strong fundamentals don't die in periods of macro stress. They compress, they coil. And when the trigger that resolves the uncertainty finally arrives, the recovery is faster and sharper than almost anyone expects. The reason is simple. Fear keeps new buyers out, but it rarely flushes out the true believers. So when the catalyst hits, there's pent-up demand, thin order books, and prices can reprice dramatically in a very short window. XPRP recovering into the 1.6 to 1.65 range would signal the market is beginning to price in legislative progress. Beyond that, if the bill clears multiple hurdles cleanly, the conversation shifts to levels that would have seemed aggressive just a few months ago. This isn't prediction, it's reading the structure of a market that's been compressed by identifiable, solvable uncertainty. Before we go any further, I need to address something that isn't about charts or legislation, it's about protecting yourself. Whenever markets are in uncertainty and people are hungry for good news, scammers multiply. It's not random timing, they study sentiment cycles the same way traders do. Right now, there's been a notable surge in fraudulent activity targeting crypto holders. Fake airdrops, impersonation accounts, phishing links dressed up to look like legitimate platforms, fake giveaway accounts mimicking well-known creators and industry voices. The playbook is always the same: create urgency, promise outsized returns for doing something small, and get you to either connect a wallet or send funds first. No legitimate figure in this space will ever slide into your DMs asking you to participate in something to unlock a reward. Nobody running a real project needs you to send crypto to them, and no verified creator is running an exclusive giveaway through an Instagram DM. The second you feel that combination of excitement and time pressure from an unsolicited message, that's the trap. That's exactly the emotion they're engineered to produce. Stay skeptical. Stay cold. The best protection you have is a trained habit of pausing before you click anything. Here's the big picture. Everything happening today, the legislative markup, the diplomatic talks, the macro data, it's all part of the same underlying story. A market that has been sitting on top of enormous potential, held in place by solvable problems, waiting for the moment when the path forward becomes legible. That moment may not arrive today. The bill might face more delays. The talks with China might produce ambiguous signals. The Fed might stay hawkish longer than anyone wants. But the direction is clear, and in markets, direction, even slow, messy, contested direction, eventually wins. The investors who tend to capture the biggest moves are rarely the ones who timed the bottom perfectly. They're the ones who understood the reason behind the eventual move, held conviction through the frustrating middle part, and were already positioned when the catalyst hit. We're in the frustrating middle part, but the dam has cracks in it now, and when it breaks, not if, when the flood of capital that's been waiting on the sidelines is going to move fast. Stay patient, stay informed, And as always, none of this is financial advice. Do your own research, know your own risk tolerance, and make decisions you can defend with your own reasoning. I'll see you in the next one.